All right, let's talk about something that trips up so many investors. You're trying to be smart, right? You hedge your position to protect yourself, but then tax time rolls around, you sell that original position for a loss, and you get this really nasty surprise from the IRS. We are diving deep into what I call the straddle tax trap.
So just imagine for a second. The market does its thing, it zigs when you wanted it to zag, and you make the call to sell a stock. You take the loss thinking, okay, at least I can use this to offset some of my gains. Standard operating procedure for an investor.
But then you go to file your taxes, and you find out that as far as the IRS is concerned, that loss you just took, it might not actually count. At least, not for this year.
So why? Why on earth would a real loss not be deductible? Well, it all comes down to these rules that were originally meant to stop shady tax shelters, but they end up catching regular, everyday investors completely by surprise.
Okay, so here's our game plan. First, we're going to uncover this hidden trap. Then, we'll decode the actual straddle rule that makes it all happen. We'll even put on our auditor hat and see how the IRS looks at this. We'll get practical with Form 6781, and then, super important, we'll find the safe harbors that can protect you. And finally, we'll look at the real financial cost of getting this wrong. So let's start with the trap itself. And I want to be clear, this isn't some obscure little rule buried deep in the tax code for hedge fund managers. Nope, this can hit anyone who's using things like options to manage their portfolio risk. All right, let's get right to the heart of it. The whole reason your loss might get put on hold is because the tax code is looking at the big picture. It doesn't see the stock you sold in isolation. If you've got a hedge, it sees those two positions as a single, combined economic unit.
And that brings us to the magic word straddle. According to the tax code, a straddle is when you hold offsetting positions. All that really means is you have one position that dramatically lowers your risk on another one. The classic example? You own a stock, and you buy a put option on it. Or maybe you own an S&P 500 ETF, but you also buy an inverse ETF. The law looks at those and says, aha, that's not two separate trades, that's two sides of the same coin.
Now, here is a really, really critical point. Your loss isn't gone forever, it's not permanently disallowed. It's deferred. It just gets kicked down the road to the next tax year, which, believe me, comes with its own set of major headaches. Let's just run the numbers so you can see exactly how this works. Let's say you sell stock A and you realize a $10,000 loss. Simple enough. But at the end of the year, that protective put option you're still holding has an unrealized paper gain of $8,000. Here's the rule. You can only deduct the part of your loss that is bigger than the unrecognized gain. So you take your $10,000 loss, you subtract that $8,000 gain, and what's left? Just $2,000. That's your deduction for this year. The other $8,000, that gets deferred.
So it really boils down to this simple four-step process every time. 1, you sell something and realize a loss. 2, you have to look at your hedge and figure out its paper gain on the last day of the year. 3, you apply that limit. You can only deduct the amount of a loss that's over and above that gain. And 4, whatever is left over gets carried forward to the next year.
So you might be wondering, why is the tax code so tough on this? Well, to get that, we really need to look at this whole situation through the eyes of an IRS auditor. They're not just checking boxes. They have what I call X-ray vision to see the economic reality of what you're doing. And this quote really says it all. The IRS works with something called the economic substance doctrine. It basically gives them the power to look at any deal and ask, does this make sense economically, or is it just a game to avoid taxes? These straddle rules were put in place for exactly that reason, to stop people from manufacturing losses in one year just to lower their tax bill, while pushing their real gains into the future.
So how do they connect your trades? Well, forget about any kind of fixed 30-day window or simple rule like that. It doesn't exist. An auditor is going to look backwards and forwards from the day you took that loss. Did you already own the hedge? That's a straddle. Did you sell the stock at a loss and then buy a new hedge the very next day? That's a huge red flag for them. They're looking for any coordinated effort to reduce risk.
So, we've covered all this theory, but how does it actually show up on your tax return? Well, it all comes down to one place, Form 6781. It's for gains and losses from contracts and straddles, and this is where the rubber really meets the road. And check this out. Here is the exact spot where the trap is laid. In Part 2 of the form, you report your loss, but then you get to column G, and it literally asks for the unrecognized gain on offsetting positions. The moment you fill in that box, the form automatically does the math we just talked about and limits your deduction.
So what is this unrecognized gain they're talking about? Well, the law is super specific.
It's the hypothetical gain you would have had if you sold your hedge for whatever it was worth on the last business day of the year. It's basically just a snapshot of your paper profit on that specific day.
Okay, I know this all sounds pretty restrictive, maybe even a little scary, but there is some good news. There are exceptions to the rule, these safe harbors that can get your trades out of straddle treatment, and you absolutely need to know what they are. So, there are a few big ones. The hedging transaction exception is mostly for businesses, not us individual investors. Identified straddles are a whole other thing with their own complicated rules, and trades with only Section 1256 contracts like futures are treated differently. That leaves the one that is most important for most of us, the Qualified Covered Call, or QCC. A covered call that you write on a stock you own can be totally exempt from these straddle rules, but it has to meet 3 specific tests. First, it's got to be traded on a national exchange. Second, you have to write it with more than 30 days until it expires. And third, and this is the tricky one, it can't be what the IRS calls deep in the money. If you can check all 3 of those boxes, you can usually deduct a loss on your stock without having to worry about deferral. Okay, so let's bring it all home. Why do we care so much about deferring a loss? I mean, you get it eventually, right? Well, it's not just an inconvenience. Pushing that deduction into a future year can have a permanent, negative impact on your finances. It can create something I like to call a tax cliff.
Look, this is where it really hurts. The value of a deduction depends entirely on your tax rate in the year you take it. So if you're forced to push a $20,000 loss from a year you were in the 35% bracket into a future year where maybe tax rates have dropped and you're in the 32% bracket, well, the value of that deduction just permanently shrank. In this example, by $600. That tax savings is gone forever. And the damage doesn't even stop there, because when you defer a loss, your adjusted gross income, your AGI, is higher this year. And a higher AGI can set off a whole chain reaction of bad things. It can push you into paying the 3.8% net investment income tax. It can make more of your Social Security benefits taxable. It can even jack up your Medicare premiums. The ripple effects are very, very real.
So here's the bottom line. The straddle rules are there to make sure your tax return reflects your actual economic situation. But if you don't understand them, a really smart hedging move can turn into a total tax nightmare. It really makes you stop and ask yourself, is your portfolio hiding a tax time bomb that you don't even know about?